Welcome to the stock market beater journey. I am Francisco, and in this masterclass, I'm going to show the first steps that ordinary busy people can take to beat the stock market without getting overwhelmed. I know this might sound too good to be true, but now I'm going to show you several stocks that have been beating the S&P 500 index over the past 5 years. The S&P 500 is like a group of 500 of the largest US companies. If they sell a lot and earn good money, the group goes up in value. If they sell less, it goes down. It's used as a benchmark to see whether these companies and the economy are doing well or not. Here we have a list of large cap companies, and 83 of them have outperformed the S&P 500 over the last 5 years. The numbers shown represent how much these stocks returned above the S&P 500. Let's check out a few of them. From this chart, we can see that the S&P 500 returned 87.1% over the same 5-year period, while Nvidia returned 2,046.3%. These figures reflect price changes from January 28, 2020 through January 28, 2025. Celestica returned 881.7% above the S&P 500 over the last 5 years. In this chart, we can see that Celestica returned 983.5% in the past 5 years versus a meager 87.1% for the S&P 500. Super Microcomputer returned 779.7% above the S&P 500 over the last 5 years. In this chart, we can see that Super Microcomputer returned 881.9% over the past 5 years versus that same meager 87.1% for the S&P 500. Let's take a quick look at the charts for some other stocks during that same time frame. I won't mention the S&P 500 anymore to save time, because we all know it returned 87.1%. Just note that the blue line represents the stock, and the red line represents the S&P 500. Morningstar shares returned over 110.3%. The card system shares returned 159.7%. Cintas shares returned 187.8%. Fortinet shares returned 336.1%. Trane Technologies shares returned 371%. I'm going to quickly share how I developed a method that allowed me to find these stocks to buy without getting overwhelmed, even as a busy professional working 8 hours a day, Monday through Friday. I graduated as a computer scientist, and as soon as I got my first job, I started to invest by myself in the stock market because I always believed in the saying, you must gain control over your money or the lack of it will forever control you. I didn't want to spend my life working and have a miserable retirement. I didn't want to have to downsize my lifestyle after I retired. I used to watch TV news stories about stocks that were crushing the market and thought, how can I spot these stocks that are going to outperform the market? Will this stock keep climbing? Or now that it's hyped in the media, will its price tank? I'm a little like you. I just wanted to consistently outperform the stock market. With busy work and personal life, I needed an approach that delivers results without constant monitoring, so I could feel in control of my financial future by making informed decisions whether to buy or sell any stock rather than guess or rely on luck. Here's the thing, things didn't go my way. I'd rake in profits on one trade only to blow it all back on the next. And sometimes I was losing more than I had already made. When a stock was soaring and I was making profits, I had no idea what was driving its price up. And when the stock was plummeting, I couldn't pinpoint why it was falling. I wasn't sure if these ups and downs were just market hysteria or if I was missing some key facts that were actually causing it to happen. Investing in stocks had become an emotional roller coaster. Market volatility often led me to anxiety, second guessing, and fear of missing out, especially since my investment strategy felt unclear. Reading everything under the sun led me to research overload, but I still felt isolated, like I was doing it all alone, under constant fear of making costly mistakes. I struggled to stay disciplined, would overact to the latest news, and realized that these knee jerk moves were a high opportunity cost in both money and time. My inconsistent results and difficulty tracking performance compounded the pressure I felt to provide for my family. Worst of all, I had no clear exit strategy, often exiting too early or holding too long. Eventually, after watching my portfolio trail the S&P 500 yet again, I had a wake-up call. Something needed to change. That's when I decided to learn how to beat the S&P 500 instead of merely hoping I might catch up. I found a system that showed me a new way, one that demystified stock analysis, taught me how to manage risk, and gave me a step by step approach. It helped me simplify my research, calm my market anxieties, and develop a strategy that fit my busy life. Now I'm sharing this with you because I know firsthand how discouraging it feels to struggle in silence. I've discovered that anyone can outperform the S&P 500 if they have the right guidance and tools. And I want you to see for yourself how achievable it is to invest confidently and watch your returns grow beyond what you ever thought possible. Now, let's dive into today's lesson. But before I tell you what you need to do to beat the S&P 500, I need to highlight the top 8 mistakes you're likely making right now that are holding you back from outperforming the S&P 500. And you need to stop making these mistakes immediately if you want to beat the S&P 500. So, the first mistake is buying stocks of companies that don't increase earnings per share. Earnings per share is a key indicator of a company's profitability and growth potential. And why is this a mistake? Because investing in companies that do not consistently increase their earnings per share can signal stagnation or decline in financial performance. Over time, companies with declining or stagnant earnings per share may struggle to sustain their stock prices and may become less attractive to investors. By purchasing stocks of companies that don't show earnings per share growth, investors expose themselves to the risk of declining stock prices and lower returns. These companies may face challenges in expanding their operations, paying dividends, or reinvesting in growth opportunities, ultimately affecting shareholder value. Focusing on companies with a track record of increasing earnings per share helps ensure investment in businesses with strong financial health and growth prospects, aligning with strategies to outperform the market. The second mistake is relying solely on social media for investment tips. Social media platforms are rife with unverified information, hype, and speculative advice. While influencers and peers can offer valuable insights, relying exclusively on these sources can lead to biased or uninformed investment decisions. Social media often amplifies short term trends and sensational news, which may not reflect the underlying fundamentals of a company. This herd mentality can result in buying overvalued stocks during hype cycles or selling undervalued stocks out of fear during downturns. Investors who depend solely on social media are more susceptible to market volatility and misinformation, increasing the risk of poor investment choices. Without conducting their own research and due diligence, they miss out on understanding a company's true value, growth prospects, and financial health, leading to underperformance compared to more informed investors who utilize a comprehensive analysis approach. The third mistake is investing only in the current hot sectors. Focusing exclusively on hot sectors, those currently popular or experiencing rapid growth, can lead to a lack of diversification and increased exposure to sector specific risks. Hot sectors are often subject to intense speculation, which can drive stock prices beyond their intrinsic value. Additionally, these sectors may experience significant volatility as market sentiment shifts, leading to sharp price corrections. By concentrating investments in a few trendy sectors, investors miss opportunities in other areas of the market, reducing the overall stability and growth potential of their portfolios. When the enthusiasm for a hot sector wanes, stocks within that sector can decline rapidly, resulting in substantial losses. Diversification across various sectors helps mitigate these risks and enhances the likelihood of achieving consistent returns. The fourth mistake is neglecting companies' cash flow analysis. Cash flow analysis is fundamental to assessing a company's financial health and sustainability. Ignoring cash flow metrics means overlooking crucial information about a company's ability to generate cash to fund operations, pay debts, and invest in growth. Positive cash flow indicates financial stability and the capacity to weather economic downturns, while negative cash flow can signal underlying problems that may lead to bankruptcy or stock price declines. Investors who neglect cash flow analysis may invest in companies that appear profitable on the surface but are struggling financially. This oversight can lead to unexpected losses when cash flow issues surface, affecting the company's ability to sustain operations and growth. Thorough cash flow analysis provides a clearer picture of a company's financial viability, helping investors make more informed and resilient investment decisions. The fifth mistake is ignoring investor psychology. Investor psychology encompasses the emotions and cognitive biases that influence decision making in the stock market. Common psychological pitfalls include fear, greed, overconfidence, and herd behavior. Ignoring these factors can lead to irrational investment decisions, such as panic selling during market downturns or chasing high returns without assessing risks properly. Failing to account for investor psychology can result in poor timing of buy and sell decisions, leading to suboptimal investment performance. Emotional reactions can cause investors to deviate from their long term strategies, resulting in frequent trading, higher transaction costs, and missed opportunities for compounding returns. Understanding and managing investor psychology is essential for maintaining discipline and making rational, objective investment choices. The sixth mistake is relying exclusively on breaking news. Breaking news can provide timely information, but relying solely on it for investment decisions often leads to reactive rather than strategic actions. News can be fleeting, sensationalized, or lack the necessary content for making informed investment decisions. Moreover, reacting to every piece of news can result in frequent trading, which is costly and counterproductive to long term investment goals. Investors who depend exclusively on breaking news may make impulsive decisions based on incomplete or transient information, increasing the likelihood of buying high and selling low. This approach undermines the benefits of a well thought out investment strategy and can erode portfolio returns over time. A balanced approach that incorporates both news analysis and fundamental research leads to more sustainable and informed investment decisions. The seventh mistake is confusing investing with gambling. Treating the stock market like a casino involves seeking quick, high risk gains without a solid strategy or understanding of underlying factors. This mindset equates investing with speculative betting, where decisions are based on chance rather than analysis and informed judgment. Such an approach ignores the importance of evaluating a company's fundamentals, market conditions, and risk management. Investors who confuse investing with gambling are more likely to experience significant losses due to impulsive high risk trades and lack of a disciplined investment plan. This behavior can lead to frequent portfolio fluctuations, emotional distress, and erosion of capital. In contrast, a strategic, research based approach to investing focuses on long term growth and risk mitigation, which are essential for outperforming the market consistently. The eighth mistake is over reliance on technical analysis. Technical analysis involves studying price charts and statistical indicators to predict future market movement. While it can provide insights into market trends and investor behavior, over-reliance on technical analysis without considering fundamental factors such as companies' financial health, management quality, and competitive position can lead to incomplete investment evaluations. Investors who depend solely on technical analysis may miss critical aspects of a company's intrinsic value and long term potential. This narrow focus can result in investing in overvalued stocks or missing out on fundamentally strong opportunities. Integrating technical analysis with fundamental research provides a more comprehensive view, enhancing the ability to make informed and balanced investment decisions that are more likely to outperform the market. Now, let's talk about the three pillars that you need to master to beat the S&P 500. Pillar number 1, consistent revenue and earnings growth. One of the fundamental principles I've observed in markets over the years is that companies demonstrating consistent revenue and earnings growth often surpass the broader benchmarks, like the S&P 500. While there are plenty of nuances to understand, the core idea is straightforward. Markets are discounting mechanisms. They look at future prospects, not merely present conditions. When a company's growth trajectory is strong and steady, investors typically reward it with higher valuations because they see an expanding stream of future cash flows. That increase in valuation over time frequently leads to outperformance relative to broader indices. Let's break down the logical reasons behind this outperformance. Think about the nature of the stock market. Each share price reflects the collective expectations of all participants, weighting the present value of future earnings. If a business can show year after year that it can consistently grow revenue and earnings, it's effectively proving its ability to generate ever increasing streams of cash. The markets, recognizing this pattern, adjust valuations upward. Once a company establishes a reputation for reliable growth, more investors compete to buy those shares, driving the price higher. The first piece to examine is why revenue growth itself matters. Revenue is the top line. It's the raw demand for a company's products or services. When revenues grow consistently, it reflects a real and sustained demand in the marketplace. For instance, imagine a software company named GrowthSoft. If GrowthSoft reports that its revenues have increased by 12% annually for 5 consecutive years, that suggests more and more clients are paying for its products. This could be due to superior product offerings, strong consumer retention, or successful expansions into new markets. That consistency alleviates fears about downturns or cyclical slumps, giving investors confidence that the company's success isn't a fluke. In turn, the stock price tends to rise as more market participants build the company into their portfolios. However, revenue growth alone isn't enough. The second crucial metric is earnings growth. Earnings, or net income, represents how efficiently a company converts that incoming revenue into profit. You might see a firm boosting 20% revenue growth, but if it's simultaneously experiencing increased costs that exceed revenue gains, its actual profitability could falter. On the other hand, consistent earnings growth is a sign of operational efficiency, cost control, and prudent allocation of capital. It means the company isn't merely selling more, it's also managing its expenses in a way that translates top-line gains into real bottom-line improvements. Why does that matter so much to investors looking to beat the S&P 500? The S&P 500 is an index of large, well-established companies. By definition, many of these companies are stable, but their growth rates can be modest once they've reached a certain size. A business that can expand more quickly and more reliably than the average index component holds the potential to outperform. It's a bit like comparing a runner who can steadily accelerate on the track to one who remains at a constant speed. Over time, the one accelerating pulls ahead, and the difference compounds. Consistency also reduces the volatility of expectations. Markets dislike unpredictability. When a company's earnings bounce widely from one quarter to the next, analysts and investors have a harder time evaluating its future. In contrast, a company that repeatedly meets or exceeds its growth targets creates a clearer picture of where it might stand in 3, 5, or even 10 years. For example, imagine a consumer goods manufacturer named Steadygrow. If Steadygrow has posted an annual earnings increase of 10% for the last 8 years, that track record makes it easier for analysts to project next year's earnings. This visibility attracts institutional investors, pension funds, mutual funds, insurance companies who value predictability because they manage large sums and seek stable long-term returns. These institutional investors tend to move significant capital. When they decide a stock is reliably growing, they often buy and hold it in large quantities, further boosting demand and share price. That's another mechanism through which stocks with consistent revenue and earnings growth beat broader indices. They become darlings of institutional portfolios, which can bid prices upward beyond the baseline return of the market. Now, let's consider the psychological aspect. Investors are people, and people like certainty. If you see a recurring pattern, like a firm consistently releasing positive quarterly reports, you begin to trust that pattern. This trust leads to a positive feedback loop. As more people buy the stock, the price increases. The company's market cap grows, and it can invest more in new ventures or cost saving innovations, which further spurs revenue and earnings growth. This self reinforcing cycle often helps growth oriented companies stand out in a crowded market. Additionally, consistent growth typically equates to a stronger competitive position. When a company grows revenue and earnings systematically, it often reflects the strong products or services, effective management, and barriers to entry that keep competitors at bay. Take, for example, an online subscription service. If it manages to grow subscribers by 15% each year while also boosting its operating margins, it's typically a sign that it's building brand loyalty and achieving economies of scale. These advantages become moats that protect the company from losing market share to rivals. Finally, the long-term compounding effect is significant. The stock market returns are cumulative. If you outperform in one year and then build on that outperformance the next, the gains multiply over time. A company that regularly increases its earnings base can leverage that growth through reinvestment, dividends, if it chooses to distribute profits, or share buybacks. All of these strategies, fueled by steady revenue and profit increases, tend to add more value to shareholders than stock that stagnates or oscillates with no clear upward trend. In sum, consistent revenue and earnings growth lead to heightened investor confidence, a more predictable earnings outlook, and frequently the attraction of sizable institutional money. This convergence of factors explain why such stocks cannot perform benchmarks like the S&P 500, and it underscores the importance of a disciplined approach, studying whether a firm's growth is genuine, repeatable, and sustainable. When that box is checked, history shows that the odds of outperforming the market tilt in your favor. Pillar number two, high return on equity. One of the core observations I've made about successful investing over many years of market participation is that return on equity matters, often more than most people realize. When we talk about stocks beating benchmarks like the S&P 500, one consistent factor you'll see in many winning companies is a high and sustainable return on equity. Why does that happen? First, let's define return on equity for clarity. Return on equity measures how effectively a company is using its shareholders' equity, the money that shareholders have invested, to generate profits. It's a straightforward ratio: net income, the bottom line profit, divided by shareholders' equity, the capital contributed by stockholders plus any retained earnings. A high return on equity suggests that business can produce more earnings per dollar of a shareholder's equity. In a sense, it shows how efficiently management allocates its resources, which often translates into robust profitability and growth over the long run. When companies exhibit high return on equity, they're demonstrating capital efficiency. Think of it this way: if two businesses operate in the same industry with similar market conditions, but one routinely posts an return on equity of 20% while the other hovers around 10%, the first company is effectively using the same raw materials like market share, employee talent, or intangible assets to generate twice the returns. This efficiency typically indicates strong leadership, a compelling product or service, and disciplined cost management. Investors reward that efficiency by valuing the company's shares more highly, which can lead to stock price appreciation above what the broad market delivers. Moreover, a company with a consistently high return on equity has a better chance of compounding its earnings over time. Compounding occurs when profits are reinvested into the business for fuel further growth. Suppose a firm has a return on equity of 25%. If it plows a significant portion of its earnings back into operations, expanding product lines, entering new markets, or investing in research and development, it can sustain or even amplify that return in subsequent years. As these earnings grow, so typically does the company's valuation, often outpacing broader market indices like the S&P 500. We should also consider investor psychology. Markets, over the long run, reward companies that demonstrate stable, above average financial metrics, such as return on equity. Why is that? Because high return on equity companies present a narrative of resilience and operational mastery. Investors, especially institutional ones, are drawn to these steady growers. This drives demand for the stock, pushing up prices even more. Over multiple years, that positive feedback loop, where strong fundamentals attract more capital, which further enhances the company's growth prospects, can result in significant share prices relative to broader market. Let's use a simple example. Imagine two hypothetical companies in the same sector: Alpha Corp and Beta Corp. Alpha Corp maintains a return on equity of around 20%, while Beta Corp's return on equity lingers at 8%. Both earn 100 million in net income this year, but Alpha Corp does it on 500 million of shareholder equity, whereas Beta Corp requires 1.25 billion. Although they made the same net income, Alpha Corp is more efficient because it uses less equity to generate the same profit. Investors see that Alpha Corp can grow faster with fewer resources. Maybe it invests that money into expansions or retains it to strengthen its balance sheet. Over time, the market typically rewards Alpha Corp with a higher price to earnings ratio or a higher price to book multiple, driving its share price above that of Beta Corp and often above the average performance of the S&P 500. Another aspect to highlight is that high return on equity can signal competitive advantages. Firms that can sustain high return on equity over many years often possess something special. Maybe they have patented technologies, strong brands, or network effects that fend off competitors. These advantages reduce the risk of sudden downturns in profitability. When you look at the stock performance of companies like this, you'll frequently see that they've managed to grow steadily for years, sometimes decades, outpacing more generic peers in their industry. This isn't just a random event, but rather the result of a strong competitive positioning that translates into a higher return on equity and often higher share price returns. Additionally, let's talk about risk management. Many folks assume that chasing high return companies is automatically more volatile. But if a company's high return on equity is driven by genuine operational excellence rather than a high leverage, excessive debt, it can be quite resilient. Of course, you must look beyond the ratio alone. A high return on equity that's primarily a function of leverage is riskier, because if the market turns on interest rates rise, those debt obligations become a burden. However, if the high return on equity is underpinned by genuine profitability and not just borrowed money, that business is frequently in a solid position to handle market fluctuations. There's also an element of capital allocation at play. A management team that consistently delivers high return on equity tends to be adept at choosing the best projects to fund and understanding when to return capital to shareholders via dividends or buybacks. When done effectively, share repurchases at attractive valuations amplify return on equity even more by reducing the equity base over which profits are measured. This can further boost earnings per share, driving the stock higher relative to the S&P 500 benchmark. Finally, consider the long-term compounding effect. The S&P 500 is essentially a broad measure of many large companies, some with strong returns on equity and some without. When you pick individual stocks with consistently high return on equity and reinvest the dividends, if any, or as the management reinvests profits, you harness compounding in a more concentrated manner. Over 5, 10, or 15 years, those gains stack up and can far exceed the more moderate pace of the overall index. The key is ensuring that the return on equity is genuine, repeatable, and driven by sustainable advantages. In conclusion, stocks with a high return on equity beat the S&P 500 because they reflect superior capital efficiency, competitive strengths, and disciplined capital allocation. Investors prize these attributes, rewarding such companies with premium valuations. Over time, this virtuous cycle of confidence, reinvestment, and growth can powerfully compound returns, resulting in a performance that often outpaces the broader market. If you are examining potential investments with an eye toward beating an index like the S&P 500, consistently high return on equity is one of the more reliable signals you can look for, provided you dig deep enough to ensure it's not just the product of short-term anomalies or high leverage. Pillar number 3. Only buy stocks of companies that have a moat. When you look at the competitive landscape of markets and ask yourself why some companies consistently outperform benchmarks like the S&P 500, a concept called competitive advantage or moat often comes into play. Over many years of observing economic cycles, I've seen again and again that a durable moat, whether it's a brand, technology leadership, network effect, or other hard to replicate edge, can drive sustained returns above those of the broader market. Let's break this down logically, using everyday examples to illustrate how it works. A moat is something that protects a company's profitability and market share from would-be competitors. Historically, the term moat conjures the image of a fortress surrounded by a deep trench of water, making it difficult for invading armies to get inside. In business, the same idea applies. A moat is any structural advantage that prevents new entrants from easily duplicating what a company does. That might be intellectual property, proprietary processes, well known brands, large user bases, or even geographic advantage. One fundamental reason that strong moat companies tend to outpace the S&P 500 is sustained pricing power. When a company faces little direct competition for what it sells, or when substitutes are hard to find, that firm can usually command higher prices or negotiate better terms. This advantage shows up in its profit margins and consistent earnings growth. Investors recognize that consistent earnings often translate to higher valuations, which in turn lead to stock price appreciation beyond the broader index. Another factor is longevity of earnings. When a company establishes a moat, it protects itself against constant competitive pressures. As a result, it's more likely to generate returns not just this year, but 5, 10, or even 20 years down the road. The stock market, being a discounting mechanism, often prices in expectations of future cash flows. If investors believe a company's moat will endure for a long time, they will be willing to pay a premium for its shares, helping it beat broader market performance. Consider a hypothetical social media platform called ConnectHub. Assume it reaches a critical mass of users, maybe a few hundred million. At this point, people flock to ConnectHub because all their friends are there, and advertisers follow because that's where people's attention goes. This dynamic is what we call a network effect. Each new user makes the platform more valuable to all other users, creating a feedback loop that helps ConnectHub remain dominant. Smaller or newer competitors struggle to lure away ConnectHub's user base because the real value is in the network that's already established. That's a moat. As a result, if ConnectHub trades on the stock market, investors see these user numbers, the growth potential in advertising revenue, and the difficulty of dethroning ConnectHub. This leads to higher valuation multiples, which can outstrip the average growth of an index like the S&P 500. Having said that, let's look now at a real company's network effect moat. Alphabet's share price, driven by Google's core advertising revenue and growth in areas like YouTube and Google Cloud, has generally outpaced the S&P 500 over several years. Investor confidence stems from Google's dominant position in online search and video, as well as its massive user base and data analytics expertise. Google's search engine improves as more people use it. Each query and click provides data that refines future results. This feedback loop not only makes Google search indispensable for users, but also an almost mandatory advertising channel for businesses. With billions of monthly active users, creators flock to YouTube to reach its vast audience, and that variety of content in turn attracts more viewers. This two-sided network effect, viewers and creators, gives YouTube a formidable moat within the online video space. Another type of moat is brand loyalty. Picture a household name in the beverage industry. Let's call them Quench. Quench's products are so ingrained in popular culture that many consumers choose them almost by reflex. And this brand loyalty is hard to replicate. Even if a competitor tries to undercut Quench on price, Quench's loyal following often remains stable. This loyalty allows Quench to maintain premium pricing or fend off discount competitors without losing significant market share. Shareholders benefit because reliable sales and stable margins usually translate to reliable earnings growth. Steady earnings over many years typically garner a higher valuation, leading Quench's stock to outperform. Let's look now at a real company's brand loyalty moat. Tesla's customers and fans often see the brand as more than just a car company. They view it as an innovative tech revolution. This deep emotional connection goes beyond standard consumer satisfaction and translates into robust word of mouth promotion. Many Tesla owners become brand ambassadors, sharing their positive experiences and helping the company attract new buyers without relying on traditional advertising channels. Investors rewarded Tesla for pioneering the electric vehicle space and maintaining a strong technological lead. Tesla's forward-thinking strategy, coupled with its passionate customer base, propelled its stock to outpace the S&P 500 over the past several years. In some cases, the moat is built on technology or patents. Imagine a biotech firm, Medicor, that has patented a breakthrough treatment for a widespread medical condition. Because no other company can legally produce or sell the drug, Medicor might enjoy a near monopoly until the patent expires. During that period, it can command robust margins if it reinvests those profits wisely, perhaps into R&D for next generation treatments. It can extend its leadership, effectively broadening or deepening its moat. These above average profit margins and growth trajectories often translate into above average stock returns. Let's look now at a real company's technology or patents moat. NVIDIA's GPUs dominate the high performance computing and artificial intelligence markets. As artificial intelligence and data center demand have soared, investors have rewarded NVIDIA with higher valuations, causing its stock price to outpace broader indices. NVIDIA's proprietary GPU designs and associated software stacks, CUDA, form a patent and know-how moat, making it the go-to solution for artificial intelligence training, visualization, and accelerated computing. Its ecosystem of developers, libraries, and tools reinforces NVIDIA's competitive edge. Competitors face steep challenges replicating these designs and software interoperability. Companies that have achieved economies of scale also develop moats by virtue of their sheer size. Think of a retail giant, Megamart. Megamart buys massive volumes of goods, which allows it to negotiate lower prices from suppliers. That advantage gets passed through to customers in the form of lower retail prices, helping Megamart capture more market share and squeeze out smaller rivals that cannot match those price points. Investors see that Megamart's moat is its size and bargain power, factors that are not easily replicated by newcomers. In many cases, these economies of scale lead to stable or increasing market share, fueling stock outperformance. Let's look now at a real company's economies of scale mode. Amazon's extensive fulfillment network and global logistics capabilities allow it to ship products quickly and cost effectively. Smaller competitors struggle to match its vast distribution footprint and warehouse automation. With millions of Prime subscribers, Amazon can spread the costs of perks like free shipping and streaming services over a large user base, reducing peer customer expenses and strengthening customer loyalty. Over the last several years, Amazon's stock price has typically climbed faster than broader market benchmarks, thanks in large part to its operational scale, expansion into new categories like groceries and healthcare, and also high margin AWS cloud services. What did you learn today? You discovered there are stocks that have consistently outperformed the S&P 500. You learned about the 8 mistakes that prevent you from beating the S&P 500, and you also discovered the 3 pillars for beating the S&P 500. Now, if you want to take it a step further, if you're truly committed to getting results, I have an offer for you. I'm about to open enrollment for my online investing course, where I'll teach you in detail how to beat the S&P 500. So, what is this training? There are two main ways there are two main ways top investors manage to outperform the S&P 500. They use two investing strategies called value investing and growth investing. You don't need to know every detail about these two strategies to use them. You just need to understand a few basic concepts about how they work. And I say this because I've developed a methodology that enables ordinary people to quickly find stocks that beat the S&P 500 automatically. Using stock screeners. Here's how it works. I teach you a concept, then give you a stock screener that does exactly what I taught you. With the knowledge you gain, you'll be able to customize that stock screener to find stocks in whatever way you choose. Because we have stock screeners that directly reflect what you learn in the course, it makes the learning process much faster. You can see right away how the theory you learn applies in practice, and you also gain a greater confidence and efficiency in your investments using our method, since these stock screeners save you a lot of research time. And because you understand what these screeners are doing, you can trust the stock selection process, which makes you feel more comfortable investing in stocks. To find stocks using value investing right at the start of the course, you learn how to locate companies that have been profitable for several consecutive years. That profitability makes a stock more attractive and tends to drive its price above the S&P 500. In the second step, you learn that those same companies also need to have manageable debt. You don't want to buy a stock in a company that's drowning in debt, unable to pay its obligations, and whose share price might drop sharply once the media starts reporting on its debt issues. The stock screener will ensure that the companies you find are financially sound. In the third step, you learn to identify stocks that are on sale. In other words, trading below their actual fair market value, also known as intrinsic value. Our stock screener will locate them for you. In the fourth step, you learn how to buy these stocks at a discount. You'll know which stocks are discounted enough to worth buying and which ones are slightly discounted or overpriced, so you can avoid them. In the fifth step, you learn to spot stocks with a moat. There's no point in buying a stock that meets all the previous requirements if the company lacks a moat. Without it, competitors can easily copy whatever the company is doing, and its share price will lose value as rivals step in. Now, these days, there aren't many stocks you can uncover using the value investing method. Most profitable companies like Google, Nvidia, and others are rarely priced below their intrinsic value. Even during bear markets, the share prices of those companies generally don't drop below their intrinsic value. That didn't happen in 2008, and it likely won't happen in the next bear market. That's where growth investing comes in. We have three growth investing stock screeners, one for large cap stocks, another for mid cap stocks, and the third for small cap stocks. Buying stocks with a growth investing strategy aims to capture rapidly expanding earnings and revenue, which can translate into above average share price appreciation over time. By focusing on companies with strong, scalable business models, growth investors position themselves for potentially higher returns than more mature or slower growing firms, often outpacing market benchmarks like the S&P 500. All of our growth investing stock screeners select companies that have consistently grown earnings over time. This typically indicates stable, effective operations and leadership. A solid track record often signals resilience to economic shifts and inspires investor confidence, which can drive share prices higher. They also look for companies with healthy margins, firms that can usually reinvest profits in growth initiatives or withstand downturns more easily, benefiting their long-term shareholders. Growing sales show increasing demand for a company's product or service. Sustained top-line growth often lays the groundwork for future earnings potential and positions the company for ongoing success. A history of strong share price performance can reflect broader market approval of a company's prospects. While past performance doesn't guarantee future returns, consistently solid stock performance often aligns with solid fundamentals and investor optimism. Meanwhile, projected earnings growth indicates a promising outlook. Companies expected to increase profits usually command higher valuations, as investors anticipate better returns, fueling stock price gains in anticipation of that growth. You can watch all these lessons online from anywhere you are, and you'll be able to download the stock screeners so you can start profiting from what you learn right away. The moment you purchase the online course, you'll get access to the video lessons and the stock screeners we refer to as investing mechanisms. YAVM, Yahoo Value Investing Mechanism, and YAGRM, Yahoo Growth Investing Mechanism. You'll also get a bonus, free support through Telegram, where you can ask questions about the course and how the investing mechanisms work. Plus, for this round of the course, everyone will get free access to a group mentoring program called Yahoo Express Investor. It includes 6 sessions, one each week, where you will have direct access to me. I normally sell this mentoring for $6,000, but you'll get it totally free. Over the mentoring, we'll do the following together. Organize your knowledge with structured processes so you can safely earn returns above the S&P 500 index. Show you how to outperform the S&P 500 index in bull markets and bear markets alike. Even if the stock market moves sideways, you'll still know how to earn above the S&P 500 index. My mission is to help you easily find safe stocks whose prices have grown far beyond the S&P 500, even if you're totally new to stock investing. Right in our very first mentoring session, you'll be able to confidently buy a stock that's already beating the S&P 500 index, even if you know nothing about value and growth investing strategies. That's because there are over 100 stocks currently outperforming the S&P 500. Now, you might be wondering, how much do I need to invest to get all this? If you lose just 1% or 2% of returns each year by not having the right strategy, That could add up to thousands of dollars over the next few years. Far more than the price of this course. Between the personalized mentoring valued at $6,000 and the Value and Growth Investing course valued at $497, for a limited time you can access all the content plus the mentoring for just $497. That means you are getting $6,000 off, like paying $1 for every $3 of a value, a deal that won't come out often. If you learn to invest and generate consistent returns, that $497 pays for itself quickly, and the $6,000 mentoring gives you all the support you need to make sure you apply the method correctly. You also have a 7 days guarantee. You can request a full refund of your money within 7 days without any justification. Just send an email to support@yahooson.com and we will refund your money without any question. It's easy like that. On top of that, I'll give you a 90 days plus 90 days money back guarantee. It works like this. After the 90th day, if you have no profit at all buying any stock within any YAVM or YAGRI mechanisms, you just send an email to support@yahooson.com showing your field orders in the stock exchange with the date you bought the stocks and the value of the stocks in the 90th day after the date you joined the YAVM community. You will receive a free consultancy where you will be taught step by step in the process of choosing stocks, and you will receive an investment plan to help you get the profits you wish. So, after 90 days of receiving the free consultancy, if you followed the investment plan and you still have no profit at all, I'll give you free access to my mentoring program called Yahooson VIP Investor. I sell it for $50,000. It's a 12 months custom one-on-one live meetings plan to fit your schedule. And I'm giving you all these guarantees because I have complete confidence in my teaching method and my investing mechanisms. Either you learn to beat the S&P 500 or you learn to beat the S&P 500. There's no alternative. Right now, you have three choices. Choice number one, decide that everything I've said is crazy. Choice number two, use what you've learned here to try beating the S&P 500 on your own. It took me years to figure it out, and who knows how many more years you might spend trying before you can consistently outperform the S&P 500. Choice number three, take me up on this offer and actually begin your stock market beater journey to fast track your investing results. I've left a link in the comments of this YouTube video, and if you're watching on the replay page, just click the button below the video. See you on the other side.